The U.S. jobs report is in for December, and the unemployment rate is the lowest it's been since the start of the COVID-19 pandemic. The U.S. added a modest 199,000 jobs last month, but the unemployment rate fell from 4.2% in November to 3.9%. But while the numbers are trending in the right direction, an alarming surge of new COVID-19 infections is causing some major problems for the labor market. The highly contagious Omicron variant is causing staffing shortages in several industries. So for more on the impact of this latest jobs report and what it says about the economy, I want to bring in Stacy. She is the Director of Portfolio Strategy at Optimal Capital. Thanks for joining us, Frances. I feel like it's been forever. I know we haven't. I feel like we haven't talked to you for a year, literally and figuratively.
I know.
So, Frances, let's talk about these numbers, because these are numbers that were sort of acquired halfway through the month of December. So, what do they tell us about the status of the economy right now?
So a couple of really interesting things about these numbers. Number one, wages increased at a faster rate than was expected by 0.6% instead of 0.4%. This is good news for people out there that are looking for jobs, but I would say do it now. The reason is that some of the things that have caused this inflation are starting to ameliorate. Supply chain disruptions, there was some manufacturing economic data that came out yesterday that's indicating that we have reached peak supply constraints. So what happened is you had supply constraints, you had lower supply, you had higher demand because people had plenty of money on the sidelines to spend, particularly stock market participants. And then that demand, people were running around looking for workers. So of course, wages went up, right? But now, as you have an increase in supply, you have less demand, particularly if markets fall because the Fed now has to tighten. Now those wage increases are going to slow and may actually roll over. So if you're out there looking for a job and you're holding out because you see wages going up, get it now.
But do the numbers at least give you hope that the economy is on the rebound? We've been talking about that for quite some time, that the economy is trending in a better direction. What are your thoughts?
Yeah, you're right. So the growth going forward is supposed to be around 4%, which is actually higher percentage-wise than pre-pandemic growth. However, there are two economies, right? There's the markets that we look at, which 40% of the population participates in the stock market, asset prices, that kind of thing, the upper 40%. And then there's the real economy. The real economy always lags the markets, right? So for instance, we had the vaccine announcement in November 9th of 2020, and the stock market went gangbusters because they're like, oh, we have a reopening. Well, we didn't have the reopening and we didn't have the vaccines yet, but the markets are going to price that in early. So now what does that mean going forward? Markets are going to start pricing in a slowing of liquidity. The things that caused all of these asset prices to go up, and basically the catalyst between the all-time highs and the catalyst behind inflation, which is the ratio of money in the system to goods and services, is going to start slowing. Fiscal spending is expected to go down by 1.3 trillion this year. That's a big slow. Even with Build Back Better, if we get Build Back Better, it's a smaller amount of money over a longer period of time. So the rate of money injection into the system from the fiscal side of things is going to slow dramatically. Now you've got the Fed, particularly with the minutes announcement on Wednesday, saying that not only are they going to accelerate their taper, they're going to consider reducing assets off of the balance sheet. So the balance sheet's almost $9 trillion. They're going to start removing the balance sheet. What is the balance sheet? The balance sheet is a ledger for money in circulation. So the aggregate money supply, or money stock as they call it now, is going to shrink. So these liquidity injections, and I use kind of crazy analogies for people, but it's kind of like we're drug addicts to this money. And we've got to start tapering off of our drug habit, and there can be some sort of unintended consequences or uncomfortable consequences to that. And so what happens is the market is going to see the Fed, talking about raising interest rates into a decelerating level of inflation. Now, what does that mean? It means that for the consumer, prices are still going to continue to climb, probably through the first half of this year. But market participants on the other side of the game are looking at the rate of increase every month, and we see peak inflation. So what's going to happen is markets are now going to start trading peak inflation and probably peak growth. We're going to see slowing growth. And then, a lot of the reason that Jerome Powell stuck to the transitory narrative, which I agreed with, rightly or wrongly, somebody can shoot me on Twitter after this interview. The transitory narrative was really around these supply constraints, right? And those are de facto starting to get better based on the manufacturing data. So a lot of what, when people say it's the end of the world with regard to inflation, the catalysts that cause this inflation are really starting to slowly turn in the other direction.
Except for this whole issue with COVID, because I feel like we keep making predictions about COVID and then we get like another variant and there's this surge happening right now. So I know the numbers are kind of backwards looking, but you've also given us factors to consider that are forwards looking. Right in the middle is this staffing shortage that we're dealing with, specifically connected to the surge in COVID cases. Is this something that the markets are considering, or is the expectation, you get COVID and then you're sick for a couple of weeks, but then you're back at it? So this is just sort of a short-term bump.
So I saw some data that was interesting, and somebody had gone back to study previous pandemics, and there was sort of a couple of years lag, and there was sort of a third or fourth wave. So we could kind of consider that we're sort of in the third or fourth wave, depending on how you look at COVID. Depending on how many variants you think you had before Delta, or what's happening with Omicron. So I think, who knows, I'm not an epidemiologist, but I think we could be having a peak COVID scenario, particularly because the Omicron, though it's highly transmissible, I think I've just recovered from it. I didn't even bother to get tested. I just, locked down. But it was so mild. It was not the, it was not the head cold I had before. It certainly wasn't Delta. I also had Delta. And as that starts to occur, I think the psychology around the virus and locking down and staying home and doing all of these, really sort of drastic measures around COVID may change if people are not terrified, if these new variants continue to be less and less severe, which is in alignment with the idea that much of the population is vaccinated, in alignment with the idea that much of the population now has natural immunity on top of vaccination or in lieu of vaccination in some cases. And so I do think that at some point this pandemic will pass. When it will occur, I don't know. But if Omicron is now what the new COVID looks like, I just don't think we're going to see people shutting down, locking down quite in the same way, because they're not as terrified of it. It's no longer, a death sentence per se.
So, Frances, one of the things that I'm so happy we're talking to you about this, because I want to get a sense from you over what we saw happening over the last quarter. There were a lot of reports around the supply chain, around inflation. Of course, inflation was a very real thing. It is a very real thing. We could talk about how it has affected the job market. But when I spoke to people, this is anecdotal, so that's why I'm asking you as an analyst, that, it didn't strike me that people who were trying to get gifts for Christmas, trying to order things online, really experienced the bottleneck that people were talking about leading up to the holidays. Did that turn out to be a real thing, or was it a might happen kind of a thing when we look back? And I do wonder what inflation is going to mean for job market.
Right. So it really wasn't as bad as we thought, right? And it kind of skewed the numbers because people actually did a lot of shopping earlier. So when you look at the retail season, people were buying the holiday season so much earlier to try and compensate for that issue. And because people shopped earlier, then you didn't have quite the bottleneck that one might have expected. But just generally speaking, these supply chain disruptions are starting as these things kind of come back online. They're starting to get better. Now, we have this situation where we have two economies, which I've talked about this a lot with you guys, and this is going to become, along with climate change and some other huge things looking back, this is going to become the problem of this decade. You go back historically, you can go to the fall of Rome, you can go to the French Revolution. And when you start to get this really crazy wealth gap, that's when you start seeing populism on both sides of politics. And that's when you start seeing, societies break down in a meaningful way. So we are there. How do we know that we're there? Well, there's the upper 40% that are sort of participating in asset prices. The S&P 500 went up 28%, 28% last year. Then you've got inflation, which we think we might get a 7 handle coming in this next print next week. Okay, so 7% there. Then you've got the wage increases. The wage increases, even with today's upside surprise, is still lagging inflation. So you've got these two economies dividing. So yes, as an analyst, we see that the supply chain issue is getting better, which is going to bring down the inflation. But to your other point, which is how is this going to affect jobs going forward? I do see a peak in wages because this meaningful uptick in wages, sadly, is a byproduct of some of these other, extreme things with the supply constraints, extreme demand. Now, the other thing to add to that picture, should the Fed tighten too quickly, overreact, reduce the money supply too rapidly, which Powell has actually been very conservative, which I think, err on the conservative side. I'm a Powell fan more than I'm a Powell critic. And that's because, when he was talking about transitory, they can turn it off so fast. They can change it so fast. They can come out and make a comment and change the trajectory of the stock market, which then starts the domino effect of so many other things so quickly. They are very powerful. So I think he's being very careful, and we'll see what he has to say during his confirmation hearings. But the thing is if the market starts to sell off, because now we're tightening into peak inflation and peak growth, which is not an ideal scenario whatsoever, you can make more policy errors that way. There's more risk in that. If that stock market starts to sell off, that upper 40% who, like you said, Vlad, went and spent during the retail season, went and bought early, paid more, et cetera, the sentiment around that and consumerism and demand could further change. So there's such a domino effect to all of these things. Now, what do I want viewers to watch? If you want to see the domino effect changing, watch the rate of increase in the month-over-month numbers on the inflation prints and CPI. Because when you start to see that those increases are decelerating, it's like reaching the top of a roller coaster and then, you're going to go down on the other end. And to those out there that are kind of holding out because they see wages going up, they're probably not going to continue to go up at the rate that they're going up right now. Take advantage of this tight labor market. Set yourself up for the next couple of years. The Great Resignation, you've got a lot of changeover. And I think that the childcare issue is going to get better if the virus gets better, big ifs and maybes. But if Omicron is the new normal, I think that's more livable, certainly, than Delta. And, go in and get your job and set yourself up for the future, because the economy we're going to get into a normalization.
Frances, Stacy, it has been a while since we've spoken to you, but we need to ensure that you're back on our air regularly, because every time you come on, I feel smarter. So we got to make that happen.
Thank you. Well,
and I know our viewers do.
I always love being on with you guys. And I was recovering from my maybe or maybe not Omicron, and I was like, I don't know if I want to do TV. Who's hosting? Vlad and Anne-Marie? Yep, I'm there.
We love that.
Love that. Thank you, Frances. Thank you. Have a wonderful weekend.
Thanks, you guys too.